Hi, everybody. It's David Fleming here from the Toronto Realty Group, and welcome to yet another installment of my interview series with mortgage broker Tony Della. And I feel like I might need a better name than interview series with my mortgage broker Tony Della. But these interviews are always off the cuff. We never really plan them. It just so happens that when we have a lot to discuss in the mortgage market, we'll call Tony in to answer some questions. I mentioned last week words like uncertainty and confusion. Those two words are not synonyms. Those are real words with their own ideas about what is happening in the mortgage market. The uncertainty is based on people have absolutely no idea what is going to happen, what is happening, and what they should do. The confusion, similarly, is because there's so much misinformation out there. People are making predictions, people are making statements that are incredibly wrong. I mean, you look at things like trigger rates, for example. Nobody really knows what to make of this. So without further ado, where am I here? I'm looking over here. There he is, Tony. Look alive. How are you, man?
Thanks for having me, man. I'm glad to be back. It's good to be back and tackle some of these questions again. But I appreciate you having me here, and no complaint. There's a lot of, like you said, uncertainty and confusion in the markets right now. So happy to answer any questions that someone might have, and give my insights on what I think is happening out there, and then offer some advice for people that are in particular situations and lend a helping hand.
Okay, amazing. We have a lot of questions this time, so I'm going to go through them a little bit quicker.
Sure.
And maybe we'll try to get a little more serious for a change. So my first question here, Tony, is from David F. He asks, what are your favorite 5 bands of all time?
Sure. Well, I mean, we got to go way back because I'm, 44. So I have to dig a little deep here. I would say, man, U2, Coldplay, Aerosmith, Bon Jovi, Guns N' Roses. And I think that's more than 5.
I was counting like my kids do.
That's 5?
Yes. Okay, that's
so,
solid.
And in no particular order.
Yeah, Bon Jovi is my wife's favorite band.
Yeah.
You can see in the background here, that's the Traveling Wilburys. They're not in my top 5 because they are a band. They had one album, that's it. They're a super group. They're like one of my favorite ever, but I didn't put them in my list. And then someone actually, they didn't email me, they called Chris and said, tell David the Traveling Wilburys had a second album and that they are a band. And I was like, this is what people do.
Yeah.
Okay, so that was a bit of a joke. Just to start us off. Okay, the first actual question here is from a appraiser. This, I think, is a bit of a joke as well. He says, if someone told you that the average price of a home today was $275,000 more than the average home price in 2019, would you consider that to be a correction? Because that's where we're at. So then Derek replies, and then appraiser replies. So guys, I'm going to skip that. I know what you're saying. You're being a bit facetious here. The first real question, Tony, here is from CEC. If the lending rate keeps increasing, will the discount on prime go back up as well at some point? In a variable prime minus 1% mortgage right now, the current discounts are more like minus 0.3%. Does that make sense to you, Tony?
Yeah. So, I mean, in theory, what we're seeing right now is the banks are not offering these big discounts as they used to, call it, 6 to 8 months ago. So What we're seeing is prime slowly getting to a point where these variable rates are becoming very close to fixed rates, and potentially even more expensive if the Bank of Canada continues to increase these variable rates. The discount comes at the expense of the institutions that are offering these discounts. So, for the most part, banks are just not offering the same discounts that people were getting 6 months ago. Call it greed, call it they don't want to. But the reality is you're just not seeing those rates anymore. So it leaves the consumer in a very precarious position where, do you take an interest rate that you think is going to come down in 24 months or 36 months, or do you bite the bullet and take a fixed rates for the next 5 years? I think that's where a bit of the uncertainty comes in right now. Is we had seen so much of these discounts for so long, and then like a parent taking away a kid from a toy, it's just vanished, it's gone. So
I don't do that with my kids. I don't know how to parent. So
yeah, so I think to answer that question, it's really at the expense of the banks. So whatever the banks decide to offer on these variances or these discounts, the consumer is mercy to those discounts.
Okay, so I think that's going to come up again. Our next question is from Anwar. Anwar says, good timing. I was just having this convo with a colleague. Can't imagine people talk real estate in this city. The Bank of Canada may be tripling rates. But how long CMA, I think it means how long before CMHC and OSFI change lending criteria so banks can make up any lost business. So this is going to play into conversations about stress test. It's going to change or potentially conversations about changing qualification. I know we have a lot to say about this and people will come back to that, but any thoughts on how long until they do that? Anwar seems to think this is a foregone conclusion.
Yeah, I mean, I think some of these regulatory bodies are feeling a lot of pressure, excuse me, to kind of make some changes or adapt to the ongoing environment of what's happening with interest rates right now. The reality is, we're governed and interest rates are governed. You go through a governing body that effectively dictates how these stress tests are applied. And every so often they get together and they assess whether or not these stress tests needs to be changed or not. Similarly, CMHC has certain guidelines that they have in place. There isn't really no time frame. They get sort of reviewed every, maybe 6 months or half a year or a year goes by before they get adjusted. But people are feeling a bit of pressure. They're looking for a little bit of ease in terms of whether it's extended amortizations or a reduced stress test. These are some of the main concerns that have been ongoing for the last, 12 months now. And no one really knows what the right answer is because we haven't seen any of these governing bodies make any hints that these changes are going to take place or going to take effect. They consistently say that they're going to review it, but nothing really ever gets done. So to answer the question is, there really isn't anything immediately happening, but the consensus seems to be that there is pressure on these governing bodies to revisit and relook at some of these issues that are happening right now.
Okay, so hold that thought because two follow-up questions, or not follow-up, but two similar questions. Carolina says, please see what creative solutions the banks and government are working on if the rates keep on increasing. What is the likelihood of dropping the stress test plus increasing amortizations to past 30 years? And then Karis follows up and says, was going to ask about the return of the 40-year amortization. So Caroline is asking about, I think her question is two things together, drop the stress test and increase amortizations. Can we just talk about those two things? I know you can't predict, but have you heard any rumblings about either of those things being on the table?
So dropping the stress test is going to be very unlikely to happen. I mean, the concern for these governing bodies is people were treating their homes like ATMs. So, the amount of money that people were tapping into refinancing these properties was a big concern. And now we're seeing that now where someone may have had a moderate rate, call it under 3%, and now they're refinancing and renewing at 6%. The bank's objective there was to make sure that people could afford to make payments in the event that interest rates rise. That's what the buffer of the stress test was designed to do. And to some extent, it's worked because you would be doing a disservice by trying to put someone in a mortgage that they can't afford to make payments on down the road. So my thought is you're probably not going to see the stress test removed anytime soon. We do have extended amortizations on the alternative side, so not with your traditional banks. So your alternative lenders are extending 35-year amortizations again. Of course, those interest rates are more expensive. There are fees associated with those premiums. But I don't think we're going to see extended amortizations with any of the major banks anytime soon. Affordability seems to be obviously an issue now that these stress test levels have increased to, just over 7%. So I think at some point in time, the concern for the banks is, do they revisit this with OSFI again and see if there is an opportunity to get into these higher amortizations? I just don't think you're going to see it again. We were spoiled for a while at 35 and even 40-year amortizations. I just don't think we're going to resurrect them anytime soon.
Yeah, and I think you reminded me, I wrote down a question here, which I'm actually going to save because the next few points are from a new and, dare I say, up-and-coming blog reader named Nobody. I love seeing new readers and new content. And you know me, I don't really care what people say as long as it's not that I'm going to kill my mother over the holidays by giving her COVID, which is like the only comment I deleted in, I think, ever. But Nobody's got some good stuff. I don't know if he's bearish or bullish. I think he's obviously a smart person. So let me read you this and give me your thoughts. He says, there's no broad agreement on cooling housing demand specifically. The Trudeau government's done some non-orthodox things in the past in regards to the economy. Given everything, it's back to the Paul Martin types being in charge. and even the Trudeau types realizing that it's necessary. Politicians, as ever, will say things about how horrible it is that the mean central bankers are being mean and horrible. They will do absolutely nothing because they know it's necessary, and an independent Bank of Canada lets them avoid responsibility. The increase in the GST rebate is a way of looking like you're doing something, but not really doing much of anything. Given the risk in the banking system and the need to cool down the housing market across the whole country, only the furthest left NDP member would drop the stress test or push amortizations out at the moment. Tony, brief thoughts on nobody's comment?
Yeah, like I think you're right. I mean, we're stuck in a spot where the consumer is looking for some form of relief, and you're not getting it from the government. You're not getting it from CMHC. You're not getting it from the other insurers, Genworth. And so, consumers are left scrambling for a little bit of help. And that help is at a cost. And we do have these institutions that are offering extended amortization, but they're expensive. You're seeing rates north of 6%. You're seeing lender fees, broker fees attached to these extended amortization. And someone's monthly budget just can't afford to assume these extended amortizations. And as we know, the banks are not making any changes on the current environment of these, extended amortizations or payment relief. So consumers are just in a very, very tough spot where they have their hands up in the air asking for help, and really no one's there to help them. So I can sympathize with the frustration. Similarly, I've got a mortgage myself. I'm, subject to these trigger rates and these stress tests and things like that. So everyone is just looking for a little bit of relief, and hopefully it comes sometime soon with some of these governing bodies. But, I wouldn't hold my breath. I don't think you're going to see, amortizations 35, 40 years again with major banks, like I said, anytime soon. So people are just going to have to, unfortunately, either change their spending habits, or in terms of employment, maybe find like, some type of additional job or something that can generate a bit more income. But I don't think you're going to see any relief on the stress test side or extended amortizations.
Okay. Nobody has a follow-up question. He says, my only mortgage question involves a time machine to get a second mortgage circa January. So Tony, if you had to pick a time machine between, number one, H.G. Wells's book, The Time Machine from 1885, or two, Marty and Doc's time-traveling DeLorean from Back to the Future, which time machine would you and nobody, which one would you pick?
The second.
That is the right answer. That is absolutely the right answer. Okay, Graham. Tony Graham says, Tony, without knowing precisely what the danger is, would you say it's time for David's readers to crack into each other's heads open and feast on the goo inside? Don't answer that.
He's a strange guy. I mean, I don't know what kind of like ooze would come out of that noggin, but I mean, it's scary what's happening inside that brain of yours.
Graham's a good guy. I think he's joking. I think he's saying the readers are going nuts. I took a lot of crap on the blog last week. I wrote
this quite well.
Well, I was very surprised by it, because it was like the consensus was sort of like, I used the example, or one of the readers said, if someone calls David and says, have you had a lot of activity on this property? Then I'm supposed to say, no, we've had absolutely no activity. And the readers, it's very tough. And I get where they're coming from. Most real estate agents are assholes, right? The industry sucks. I'm trying to tell people what really happens.
Sure.
But like, if somebody says to me, David, have you had a lot of interest? I'll say, yeah, there's been a fair bit.
Sure.
I mean, even if there's been none, I'm going to say, yeah, there's been a fair bit. And there are people that are saying, you just lied. You can't do that. So I kind of wrote a follow-up today. It wasn't intended to be a follow-up. I was talking about the words final offer, because someone said final offer, and my cynical side was like, that doesn't mean anything. And it sort of turned into a retort of sorts. But yeah, I did take a lot of crap on the blog last week. There were a couple people that were like, he's not wrong. A couple people that were like, let's give him a break. He writes free stuff for us. But man, I was shocked. And then another agent called me, and a very religious guy, and he took me to task for it. Okay, enough of that. So Ace Goodhart, this isn't really a question. Ace, if you're okay, I'm going to scroll by this. It's more of a comment. And Tony, you've, I think, read all these. Nobody goes on and talks about some quick math, which is awesome. And then Ace and Nobody kind of have a back and forth. Condo Dweller. So this is important, because he says he's asked before, and we've never answered it. So we absolutely have to do right by Condo Dweller, because he's one of the top blog readers on TRB. Says,
Yeah.
I've asked this question before, but I haven't seen an answer. At renewal time, the generally accepted occurrence is that your existing lender renews your mortgage. Commenter hinted on a recent post, it's possible your current lender might not renew. I know that mortgage loans are callable. How realistic is this scenario? So I hope you're following, Tony. You let me know. I have $1 million mortgage with Bank A. Both family members lose their jobs in a recession and the bank won't renew. Am I forced to sell my house to pay back the bank if I'm underwater by 300 grand? My only option is declaring bankruptcy. Alternative lenders where I could lose my kneecaps are not an option. Would a bank ever ask to see proof of income before renewing and not renew if it can't be proven? Did you follow all that?
Yes.
Can you comment?
So, I mean, I think Conor Droller is one of the savvy readers and blog posts. So I kind of
don't let it go to his head.
I have a soft spot for Conor Droller. So
Everybody
let me and all the readers, of course, but I'll break it down a little bit more systematically. So if you have an existing mortgage with your current lender and that mortgage comes up for renewal, typically what happens is you're going to get a call from that institution and they're going to say, here are our current renewal rates. Are you interested in renewing in these terms? Now, the benefit to that is you don't have to requalify at the stress tests and you don't have to provide proof of income. You don't have to provide any information aside from negotiating a new rate. So to go back to his original statement is if you lost your job and you did not disclose that to the lender, they would have no way of knowing that information. Now, if you're volunteering the information, then they could come back to you and say, well, you're not working. How do you plan on making the mortgage payments? I'm going to be a bit facetious with Conor Droller. Let's say, for example, he lent someone $100 and that person he lent $100 to did not have a job. How comfortable would he feel that that person could pay them back? The answer is probably not very comfortable. The banks are in the same position. The banks are in a position where they're providing you with a loan of their money and they're expecting you to pay it back. So when you say to them, I don't have a job, my argument is, what do you want the banks to do? The banks are in a position where they're lending you money. You've agreed to terms to pay it back. And now for whatever the unfortunate reason is, you can't pay it back. So the answer is either you find a job again, or you sell the house to repay the loan under those terms. Now, where it gets a little bit tricky is if you decide to move institutions, then what happens for any consumer is you have to requalify at these stress test rates. So you requalify at the stress test rates, and then you also have to provide proof of income, your T4s, job letters, all that stuff. But the difference, to answer his specific question, is when you're renewing with your existing lender, you're not doing any of that. So you can technically just renew at the terms you're negotiating with that institution and not provide any information to them aside from negotiating a rate.
Conor Droller, did you get all that? So he's got a second question, completely unrelated. Are banks cutting back on Helocs? I heard that credit unions won't do a HELOC to access capital on an investment property. Are banks the same? Say someone wanted to leverage their investments by using an interest-only loan like a HELOC. Are banks willing to play ball? Asking for a friend.
The answer is I haven't seen any of this stuff. The reality is if you qualify for a HELOC, then the banks are extending it. We haven't seen anything where a bank is not offering a HELOC simply because they don't want to. The reality is if you qualify for a mortgage and line of credit, then they're going to extend that product to you.
Okay. I got an emailed question in that's about HELOCs, so don't let me forget that. I'll come back to that at the end. So I feel bad because I skipped Ace Goodhart's comment. It wasn't really a question. But he said, you might want to look at how many people actually have mortgages. A lot of us don't. Quick search on the internet comes up with this number. Just under half of Canadians own their home outright. So he's saying 50% who don't own houses don't care what the interest rate is. And he's saying, how many people will be affected during a bubble, somewhere in the 5% range. So my question to you, just to keep Ace engaged here, do you have any idea whether or not that number is correct?
Yeah, I don't know. Something seems off to me about that number that, half 50%. The people don't have a mortgage. It seems a little bit skewed. I don't know where they're pulling this material from or what the source is.
I think it's way more, wouldn't it be?
Well, I would think that many more people have mortgages rather than not have any mortgages
Oh,
now.
I thought it was the opposite.
No, I mean, I would, again, this is my guess
Okay.
or assumption, but I think there are more people that have mortgages than less. It'd be interesting to see sort of like the population growth
Yeah.
and see sort of where we're at with how many people are retiring or what the baby boomers are looking like. But I would think it's the other way around. I don't know where that stat came from. I remember reading something along those lines.
Mm.
But if I had to guess, I would have thought it would have been the other way around, that there are more people with mortgages. Maybe it's an age thing, like you go to a bar, you talk to someone, 9 times out of 10, someone's telling you about their mortgage.
Interesting. I would have thought for some reason, like, and again, it depends. You have to think people aged 18 to,
Sure.
infinity.
Sure. And,
Because
and that's what I mean by like, you would want to assess the population, right? Like if half the population is under, call it 25 or whatever the case might be, and where these regions are province wide or provincially wide, then, I think typically anyone 30 and above would probably have a mortgage. If they're not, they're renting, but I'd be curious to see what that gap is in terms of age of how they're assessing that number.
okay.
And
So I'm just
if he
yeah.
has the source, I'd be interested in seeing, just doing a little bit more research on where that information came from.
Okay. I'll post that to him. A lot of people post emails, but they're not real.
Sure.
Email at admirals.com. We get that all the time. Interestingly enough, some of the anonymous readers, if I look back at when they first posted, their very first comment used their real email address. So a lot of you guys that are anonymous, I know who you are. We should have a blog party one day. Okay, so Ace and Condo Dweller have this wicked back and forth. There's no real questions in there, but thank you guys for doing this. It's incredible value add. I know the readers love it. A buddy of mine says, I don't read your blogs, I read the comments. You're a dick. So that's Mr. Sunday. Just so that you know, that's his code name. So Vancouver Keith, he says, in terms of market share, how big has the non-traditional real estate financing sector become? The area outside, the area of lending outside traditional banks and credit unions, is it growing significantly?
Yeah, I don't have the exact stat, but I would say it's, if I had to guess, maybe it's getting to 40, 50% where, one in every 2 deals is either, with a major bank or with an alternative lender. And so what you're seeing as the banks begin to tighten their criteria for financing is consumers are left going elsewhere. And what we're seeing with some of these alternative lenders is, like I had mentioned earlier, is you're seeing these extended amortizations, and you're also seeing these extended ratio guidelines. So even though you're qualifying at these stress test rates with a major bank, you have your GDS and TDS ratios that you have to be sort of in this confined umbrella within. With these alternative lenders, they can actually extend that stress test number, allowing more affordability for that individual. So you're slowly beginning to see that people who cannot traditionally qualify for a major bank are now being qualified with these alternative lenders.
So
and
you
again,
kind of answered
at higher rates and fees, unfortunately.
So my question, and tell me if we're double dipping here, the one that I wrote down earlier, I was going to say, you and I in the past have talked, we've had a few clients where we've said you might benefit from going to an alternative lender. The alternative lenders, they will charge a higher rate. There is usually a fee, right? But can you tell the readers here the advantages and disadvantages, just generally speaking? And then more importantly, why is it? This was my question. Why is it that the rules for alternative lenders are different than the big five banks? Where do those rules come from? Are we talking that this is the government says to the banks, you have to do this, and alternative lenders, you guys can do this? Or is it just based on, some are publicly traded companies, some are private companies?
Yeah, no. So you have provincially regulated institutions, and then you have non-provincially regulated institutions. For the most part, major banks follow a governing body, same as these non-traditional banks. And Fisco is one of these governing bodies. And what happens is you have to sort of be within a certain criteria of doing certain things within those confines. And what we're seeing is, we don't know why some institutions can offer these extended amortizations. They're kind of playing behind the scenes, and they're willing to kind of maybe take a fee, or maybe not a fee, but like a fine if something comes along. Major banks are sort of very, very tight when it comes to lending. You're not going to see them play around with extended amortizations. You're not going to see them play around with these stress test elevations. So you have these governing bodies that are more stringent to these banks than they are with some of these non-traditional banks. And then you have your credit unions that are not provincially regulated, so they can kind of do their own thing here and there. And then there's a second part to that question is, why do people want to go to these alternative lenders? And the reality is you're sort of treating this like a Band-Aid solution. If you found the property that you loved, and let's say, for example, you're a teacher and over time you earn more income, but currently right now you're just started your job, you earn a certain amount, an alternative lender will extend financing to you because they can do these extended amortizations. And over time, that you can move back to a major bank as you earn more income. The banks just aren't willing to do that, for example, right now. So you treat this sort of like a Band-Aid solution, knowing that in a year or two, you can move back to a major bank because you'll either have more income and then less of a mortgage debt as you're paying it down. So there are multiple reasons why typically people do this. One is, if you're self-employed, if you don't have traditional forms of income, if you have bruised credit or damaged credit is another one. And you just income, if you're not earning enough to qualify with a major bank, you want to move to these alternative channels. And then with the hope of moving you back to a major bank in a year or two.
Okay. Last question. This was the one I mentioned that was emailed. And then I was just thinking I had another question. Oh, yes, I remember. Okay, we're running short on time because Zoom's going to kick me off. Here's my question here. Oh, this was emailed in. Okay, regarding home equity line of credit. If I am retired and want to use income from my home, I can borrow a substantial amount as a down payment on an investment property. What is the interest rate, and do I need to qualify based on any income? So I think what this person's saying is, if I don't actually work and make any money, and let's use an example, maybe someone owns a house that's worth $2 million, and they say, I'm going to take out $250,000, and I'm going to put a 50% down payment on a place that's 500 grand. Can they qualify without having income? And then what's the rate that they're paying on the HELOC compared to, say, traditional mortgage rate?
So when you're pensioned or retired, you have a certain amount of income that you're bringing in every month. Again, the threshold right now in today's environment is, take that amount, whether it's employment income, pension income, retired income, multiply it by about 4. That's typically what you'll be able to carry in the form of mortgage debt load. So, someone who's retired and who has a home that's free and clear wants to buy an investment property. There are certain vehicles that we can access now that gives them the opportunity. But one of the opportunities that they have is they can refinance their current place, pull out whatever they qualify based on their pension income, and whatever that amount is, they can buy an investment property. But again, you have to qualify for that investment property under the same income that you're using to pull the money out. The other option for people who are retired and pensioned is there's something that's called a reverse mortgage, where if your home is free and clear, we have institutions that will lend you a certain amount of equity in the home, and you don't make any payments on that property until, God forbid, the person either passes away or you want to sell the home entirely. So to answer that question is, you always have to qualify for the amount of money that you're pulling out of the property. And then secondly, for the property that you're looking to purchase as an investment vehicle. So to answer that question is, whatever this individual's pension income is, you would take that amount, multiply it by 4, and that's typically what you can qualify in the form of mortgages across all the properties that you're looking to have.
There's no free lunch, huh?
There's no free lunches.
Okay, so my last question here is, what's your prediction for the next Bank of Canada announcement? Is it 25 points, 50 points, or 75 points?
I think we're probably going to see a 50-point rate hike, is my prediction.
That was a 5.
I think 75 is too aggressive. 25 is probably not enough. And I think we're probably going to see 50. And my prediction is we probably won't see another one in December. So
yes, I agree with that.
This might be the last of it, hopefully. But we'll see.
And so where's the variable and the fixed November 1st?
Yeah, so variable rates are trending at maybe around the 5% range, maybe just a touch or hair under that. And then 5-year fixed rates are trending, 5.19, 5.29, somewhere in that ballpark, depending on, the amortization, the lender. But, variable rates are not as attractive as they used to be. Fixed rates are just, a touch over 5%. So, optically, they're not nice to look at.
So, well, based on where they were, but
yeah,
our parents laugh at us, right? And that's going to be the story of the market moving forward.
Yeah. And I think I don't know if you had any questions on trigger points specifically and how those work.
I mean, we covered that last time. We did a whole blog.
Yeah.
No one asked that. I was just joking around because I keep hearing horror stories from even a few folks in the office. One colleague of mine,
I'm one of them.
Oh, well, a colleague of mine.
I'm one of them in the sense that TD called me and said, "Hey, Mr. Della Sciucca, I just want to let you know that you're going to have to give us a little bit more money because you've hit your trigger rate." So, as you know, like you have these trigger points that when you're just not giving the bank enough money and interest to cover your interest costs on your payment, you're going to get a tap on the shoulder saying, "Pony up a little bit more money." So
I've heard that. One of my colleagues, her mortgage went from 6,000 to 9,000, and she's like, "Yeah, we can handle it." She's like, "It's just, it sucks." So that's it, man. That's it. That's all the questions, Tony.
Well, look, I'm thanks again for having me on. And if there's more questions or a part 2 to this, let me know. But it's always nice to entertain these questions and, give my 2 cents and my thoughts of where things are now and, where things are hopefully going to be in the next 6 months. I hope that rates begin to subside a little bit in the next little while. I know that the housing market is somewhat cool. The last couple of weeks have been a little bit slower, and people are just on, pins and needles about, whether or not they want to enter this market and inherit these high rates. But at the end of the day, if there's a house that comes up that is something that you've been waiting for and it's at a discounted price, it's hard to pass up, so.
Listen to this guy. Sounds like he's selling real estate. All right, Tony.
I don't know how I'd be able to handle the weekends.
Oh yeah, tell me about it. Guys, viewers, readers, watchers, thanks so much, guys. Any follow-up questions, Tony's contact info will be there. Feel free to comment in the blog comment section below, and we'll see you next week. Bye, guys.
Thanks for having me. Bye, guys.